We're going to look at our types of business and business activities. Welcome to Accounting and Technology. Forms of business organizations. Accountants frequently refer to a business organization as an accounting entity or a business entity. A business entity is any business organization, such as a hardware store or grocery store, that exists as an economic unit. For accounting purposes, each business organization or entity has an existence separate from its owners, creditors, employees, customers, and other businesses. This separate existence of the business organization is known as the business entity concept. Thus, in the accounting records of the business entity, the activity of each business should be kept separate from the activities of other businesses and from the personal financial activities of the owners. As you will see shortly, the business entity concept applies to the four main forms of businesses: single proprietorships, partnerships, and corporations. Thus, for accounting purposes, all four businesses forms are separate from other business entities and from their owners. A single proprietorship. A single proprietorship is an unincorporated business owned by an individual and often managed by that same person. Single proprietors include physicians, lawyers, electricians, and other people in business for themselves. Many small service businesses and retail establishments are also single proprietorships. No legal formalities are necessary to organize such businesses, and usually business operations can begin with only a limited investment. The most attractive feature of a proprietorship is that there is no double taxation. Both proprietorship and partnerships do not pay taxes on profits at the business level. The only taxes paid are at the personal level. This occurs when the proprietors and partners pay taxes on their share of their company's income. On the other hand, a business owner is personally liable for all debts of his or her company. This is called unlimited liability. If you are a sole proprietorship and the debts of your business exceeds its assets, creditors can seize your personal assets to cover the proprietorship's outstanding business debt. A partnership. A partnership is an incorporated business owned by two or more persons associated as partners. Often the same persons who own the business also manage the business. Many small retail establishments and professional practices, such as dentists, physicians, attorneys, and many CPA firms, are partnerships. Unlimited liability is even riskier in the case of a partnership. Each partner is personally liable not only for his or her own actions, but also for the actions of other partners. If, through mismanagement by one of your partners, the partnership is forced into bankruptcy, the creditors can go after you for all outstanding debts of the partnership. A corporation. A corporation is a business incorporated under the laws of a state and owned by a few stakeholders or thousands of stakeholders. Almost all large businesses and many small businesses are incorporated. The incorporation is unique in that it is a separate legal business entity. The owners of the corporation are stakeholders and shareholders. Stakeholders do not directly manage the corporation. They elect a board of directors to represent their interests. Accounting is necessary for all forms of business organizations, and each company must follow general accepted accounting principles (GAAP). Types of activities performed by business organizations. The forms of business entities discussed in the previous section are classified according to the type of ownership of the business entity. Business entities can also be grouped by the type of business activities they perform. Service companies, merchandising companies, and manufacturing companies. Any of these activities can be performed by companies using any of the three forms of business organizations. Service companies perform services for a fee. This group include accounting firms, law firms, and dry cleaning establishments. Merchandising companies purchase goods that are ready for sale and then sell them to customers. Merchandising companies include auto dealerships, clothing stores, and supermarkets. Manufacturing companies buy materials, convert them into products, and then sell the products to other companies or to the final consumers. Manufacturing companies include steel mills, auto manufacturers, and clothing manufacturers. All of these companies produce financial statements as the final end product of the accounting process. These financial statements provide relevant financial information both to those inside the company, management, and to those outside the company, creditors, stakeholders, and other interest parties. The next section introduces four common financial statements: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Important points to remember. Business entity is any business organization such as supermarket or accounting firm that exists as an economic unit. The three most common types of business entities are sole proprietorship, partnership, and corporation. From the accounting perspective and its purpose, these types of business are considered separate entities from their owners. The corporation is only one considered as a separate legal entity.